Rate rises are over. It's finished. The question today is going to change from, is the RBA going to increase interest rates further that we're all obsessed with, to how long will interest rates remain at this level? That is one of the most important questions for the short-term direction of property markets, particularly in Sydney and Melbourne, which are far more interest rate sensitive than other capital cities. In this episode of Australian Property Talk, we're going to go through the 4 reasons why the RBA are pausing interest rates, and we're going to take a look very clearly at how long interest rates are likely going to remain at this level. Now remember, at 4.1%, the cash rate is extremely restrictive. Borrowing capacities are down 30% in about 15 months, and that remains true today at this cash rate. No longer increasing interest rates does not mean that financial conditions have magically become easy. In fact, we're going to be living through these tight economic conditions and these tight financial conditions for borrowers, homeowners, investors, all Australians with a mortgage. We're going to be going through this period now. For how long is the question before we start the rate cutting cycle, which may trigger the next sort of stage of the property cycle and trigger the increases that typically happen when rates fall, particularly in Sydney and Melbourne. So let's get into it. For those that don't know me, I'm Reedham Syed, founder of Confidence Finance, host of Australian Property Talk. I love talking about economics, property markets, property investing. If you enjoy that, hit that subscribe button. And yeah, welcome to the show for the new listeners out there. So let's get into it. The number one reason why the RBA are pausing interest rates: inflation. Inflation levels are coming down quicker than the RBA's forecast pathway. So at the end of 2022, inflation was at 8.4%. We hit the peak level of inflation then, and inflation's been trending back down over the course of the year. Now, we expect inflation to be about 4% for the 2023 calendar year. Today, we're at 4.9%. So that data set for today includes, 6 months of last year of really high inflation. And in the first 6 months of this year, inflation levels are coming down in line with what the RBA expect and want to see. Now, you'd expect that to happen. Interest rates have gone up so much. So, that's putting pressure on households, and inflation's coming back down and the economy is slowing. So that's the number one reason. Inflation is coming back down in line with the RBA's sort of trajectory and time frame. It's beating it a little bit, which gives the RBA the room and breathing space it needs to let all the rate rises that they've already done filter through to the economy. Remember that monetary policy, so interest rate increases, take about 12 months to feed through to the economy in general. So, it works with you increase interest rates on day one. About 90 days later, people start feeling that repayment increase hit their bank accounts. Eventually, they adjust their patterns, and businesses start to feel that, and notice that, hey, look, there's less people buying coffee or less people buying my goods and services, and then eventually, after a little while, they adjust, and unemployment starts rising as a result. That's what rising interest rates is designed to do: cool the economy down, bring inflation down, and bring unemployment. Bring employment pressures down and effectively cause unemployment to go up a little bit to slow down inflation. So that's the number one reason. Inflation is coming back down. Here's a chart of it just earlier. It shows that the trajectory of inflation is down. It's in line with the statement of monetary policy, which is what the RBA forecast. So that takes all the pressure off the RBA from increasing rates further because the trajectory is coming down. Now, the key thing here is the RBA are willing to be patient on the return to ban, more patient than other countries. So the reason why they've paused at 4.1 and other countries are, nearly 6%, the US and New Zealand, for example, is the RBA are allowing inflation to be outside the RBA band for, all of 2024 and pretty much the majority of 2025 as well. So they want to see inflation back in band in 2025. By the end of 2025. So, they're forecasting a trajectory back down, roughly 4% this year, 3.5% next year, and down below 3% in 2025. So that's their trajectory. It's a slow burn back, and we are meeting that trajectory on inflation. And because we are, they don't need to increase interest rates. We're beating that trajectory, actually. So, if this is their pathway and we're actually performing a little bit better than it, then it takes pressure off raising interest rates. So that's the number one reason why the RBA have paused interest rates. The second reason is households are feeling the pressure of rate rises. So when they began this rate rising cycle, they would have assumed as you increase interest rates, the economy slows down. Now, we are seeing this in all of the data today. It's, August 2023 now. So, it's been a fair bit of time since all these rate rises have occurred. Data is coming out and it clearly shows the Australian economy is responding to higher interest rates. And in particular, Aussie households are spending less money. Just earlier today at 11:30, we released our national accounts and they showed that Australia is in a per capita recession. That is, per person, we're producing less than what we did in 2022. So that isn't the first time we've experienced this, but it does signal that the Australian consumer is slowing down their spending. That was a big part of the reason why. More specifically, household spending has barely changed over 2023, despite the higher population. Per family, we're spending less, but there's more families out there, more people out there. So on balance, overall, we're spending roughly the same amount, no growth there. And on discretionary items, so, excluding food and, the things we must buy, food, petrol, just to live, discretionary, the amount that we get to choose to spend, that is falling back. It's going backwards. So, imagine clothing stores, for example, they are selling less stuff today than they were last year. We're officially also in a retail recession where the volume of goods and services that the retail sector is selling is falling. So overall, the total value is rising because of inflation, prices going up, but the amount that they actually sell is falling. So the second reason is the household sector is falling. There's a lot of data showing it. And because of that, the RBA can clearly see that their work in increasing interest rates is working and that they can take that gas off those rate rises and, let their work do its magic. As a result, you're starting to see the economy slow down. And they're seeing that in the data, which will please them enough to pause interest rates. The third reason, and I've already touched on this, is economic growth is fairly slow in Australia. So because the economy is slowing down and inflation's coming down, they got less pressure on interest rates. So what we're seeing in the Australian economy is the sectors that are propping up growth are a function of what you'd expect. So interest rate sensitive sectors, so we're talking about households and businesses, they're struggling. So inventories, that's like the amount of goods that businesses are selling, that's falling. Households aren't spending more. These are the two main components of GDP and GDP growth. They're basically doing nothing or moving backwards. So technically, we're in a per capita recession already, and the economy isn't growing very much on two of the major interest-sensitive sectors. Now, where growth is coming from is our currency is devalued 10% this year. So, if you make everything we sell overseas 10% cheaper, more people will buy them. That's just a standard adjustment that's occurring, and it's leading to an export volume increase. We're selling more stuff overseas because it's cheaper, and that is propping up our GDP numbers. So GDP is a little bit of a funny one because Australia hasn't really had a recession for 3 or 4 decades, and we've had these per capita recessions. What policymakers do when we're in this situation, nobody wants an actual recession. Look, the RBA is even setting their own bandwidth as the narrow path is positive economic growth. It's completely arbitrary, the benchmark that they've set. They haven't said positive growth per person. They just said positive economic growth. That's a benchmark we've set. The reason is nobody likes a recession. It gets the media involved. Everyone will be, after someone's head. It's just a nasty word. It scares people. So we don't want an official recession, and we've avoided this by the currency devaluing 10%. We're all feeling poorer in that way. The other big one is we're bringing in more people. So that increases the amount of people here. So obviously we're going to be buying more stuff because there's more of us. So even though each of us is buying less, there's more of us in total. And that's really masking the story. But you can't hide it. The Australian economy's key metrics are not that great. Inflation too high, higher than wages growth, been that way for a little while. The economy not growing, moving backwards per person or rising very, very marginally because of a currency devaluation, not because of anything else. These aren't positive stories, and unemployment is now beginning to rise. Obviously, that is a wonderful, wonderful legacy and a wonderful story for Australia. 3.7%, nearly 200,000 people more that off the unemployment line. About 160,000 people off the unemployment line in the last 3 years. Absolutely wonderful story, but that's in reverse gear now. So the employment market will continue to deteriorate over the course of the year and next year, and even maybe in 2025 as well. But we're coming off such a strong base that's a positive story. So on that metric, we're doing okay, but on the other metrics, the Australian economy is really slowing down. Because the economy is slowing down and inflation's coming down, the RBA don't need to increase interest rates further. Now, the fourth reason, this was mentioned in the statement, it's been on the lips of everyone in policymaking land for a little while, is what is going on with China. The Chinese economy is slowing down. They're trying to prop it up with stimulus, but the Chinese economy is clearly slowing down, and Australia gets impacted by the Chinese economy slowing, more so than others. They're one of our biggest trading partners. They buy a lot of our stuff. So as a result, if they slow down or if they catch a cold, Australia does too. So that's a part of the reason why in this statement, the RBA have noted a global concern, and in particular, the Chinese economy. In Treasury and RBA land, we've got teams that specifically monitor just how the Chinese economy is performing. And data is a little bit patchy here, and understanding their economy is a little bit patchy here from Australia, a little bit more questionable in terms of their data metrics and how reliable that data is. But it's undoubtedly clear the Chinese economy is slowing down, and that could have impacts on Australia. So there's huge question marks, uncertainties there. That's another reason why the RBA paused, because that can, it's a downside risk to the Australian economy, and they did note it specifically in this statement, and they haven't in the past. So those are the key reasons why the RBA have paused. That's the four main reasons. So now that we've covered what the RBA are doing and why they've paused rates for 3 months in a row, let's answer the main question. How long will interest rates be at this level? Let's take a look at history. So if you take a look at this chart, what you'll see is the average duration of interest rates being at its peak level at rate rising cycles is actually only 10 months. In recent times, this isn't that recent because we haven't raised rates for over a decade, but in 2010 to 2011, when we last rose rates, so this is after the GFC and reducing interest rates a lot, the economy recovered, done pretty well. We overcooked it a little bit, so we need to raise interest rates. 2010, 2011, it took 12 months for the peak cash rate before rate cuts kicked in. The longest we've ever been at the peak cash rate here is 17 months. So that's, another 14 months from this point. So, that's the end of next year. If we have the longest peak rate cycle, assuming that there's no more rate rises, we're towards the end of next year at this cash rate before rate rises kick in. If you go with the average, we're probably around mid next year or early to mid next year. So you're probably looking at March, April, May. Now, this is just history. It's over the past 50 years. Obviously, a lot has changed in how reliable is data from 50 years ago about the economy then, but it does provide some signaling about how long the economy can handle high interest rates. For those that have stuck around, do me a big favor, hit that subscribe button. I love talking economics, property, and jump on our podcast for those that aren't there. Nearly 2,000 weekly listeners, Australian Property Talk on all podcasting platforms. See you next time.